And welcome. This is Mary Ellen McGonagle with your Friday afternoon MEM Edge show. This is the show where we bring you where the action is in the broader markets, as always, with an eye toward helping you be prepared not only for next week, but beyond. So we are in a rather dicey period here with the markets. So let's jump right in. Take a look at what we are going to be covering today. And as usual, we're going to begin by taking a look at where we closed the market and beyond. We're going to take a look at some of the sectors, what's taking place beneath the surface. Again, a very choppy period, but generally downward this week. We'll get into that. Also, some of the top headline news that drove price action as the week progressed. Also, taking a look at inverse ETFs. I do believe we looked at this before, but I have several others that I want to share with you should the markets continue to falter. Also, we'll take a look at recession stocks amid what some are calling global growth recession, or certainly fears are out there. China has begun a partial lockdown and Europe is struggling. So we'll take a look at some of those stocks that fare well in periods when the economy is slowing. More for your watch list, but we'll get into that. Also, the pullback that has taken place this week in commodity stocks. Is it a buying opportunity? We'll get into that as well. So let's go ahead and take a look at some of those headline news. Of course, we did see the S&P pull back, and just so you know that this is being recorded about 2 hours before the close on Friday, but we certainly have enough information. And at this time, the S&P 500 has broken below support and is now finding that area as upside resistance. We did get news at the beginning of the week. Job openings did increase and consumer confidence rose. And this was news that investors were not particularly fond of. It does give the Federal Reserve license to continue with their somewhat aggressive rate hike cycle. So the markets did pull back on that news. And then with that, there were several Federal Reserve presidents that were speaking this past week. And a number of them did reiterate that suggestion that we could see the Fed funds rate into that 3.5% rate well into 2023. Other news, this was more news that the broader markets were not particularly fond of. Brent crude continues to drop. This is important certainly for energy prices, but also for the outlook for inflation. We'll take a look at where that level is into the close today. And then also unemployment rate did rise despite a strong jobs report, and that was this morning. The news is rather mixed. We'll see how it is interpreted. Originally, it was viewed in a bullish fashion, positive for the markets, but we are deteriorating into the close. So we will get into all of that and more. Let's take a look. Here we are, daily price chart of the S&P 500. And as I did point out earlier this week, the S&P 500 broke below this 50-day simple moving average. And this had been an area that we were looking to for potential support. We sliced through that, and the volume was pretty high on that break. So not what you want to see, certainly during a summer week going into a long weekend. When you see that high volume, you can bet and certainly pay closer attention to that. Let's take a look at the outside momentum indicators. This RSI is now and has been in negative territory, and the stochastics, a faster moving momentum indicator, down here in negative territory. We did see buying into the close on Thursday that conceivably was beginning to push these momentum indicators at least sideways. That initial rally helped, but again, into today's close, we're now down at this time about 0.25%. So let's move on. Take a look at some of the price action among the S&P 500 sectors. We want to stay on top of where relative outperformance is, and equally important, is there any rotation that is occurring in light of the markets? So this week up here in the forefront, energy And I will tell you that the energy group has underperformed. Let's take a look, however, at this group chart here for XLE, these energy stocks. We can see we pulled back quite orderly to this 21-day simple moving average. We're seeing about a 2% rally today. I'll go ahead and pull up the weekly on this as well to provide you with further long-term intel. But most importantly, from my work, I'm on the lookout for this MACD black line up through the red to give me conviction that a longer-term uptrend may be in the beginning stages here for the energy sector. I do have a name on my MEM Edge suggested holdings list, but I am anticipating adding if we see a continuation rally from this pullback. So let's go ahead back, take a look at some of these other sectors up here at the forefront. Utilities have been holding in well, one of the few that is above both this 50 and 200-day simple moving average, but not a great looking chart. The RSI trending downward below that net neutral, and then we have that MACD trending downward as well, but still up here in positive territory. So a little bit trapped here, but there are pockets of strength, and I will share with you two names in the utility space that are faring quite well. So as we move on, and I did fail to mention that I do, when looking at a 2-month daily price chart view of these 11 sectors, I like to add this RSI, that's that relative strength indicator, sort the list in descending orders. So up here in the upper left quartile are your relative performers, your relative outperformers. And then as we drill down, these are going to be your weaker areas. So we can see technology down here. It's having another very weak period. It's down over 4.5% for the week, and similar to its steep underperformance last week. I will share with you a chart that will explain this a bit more as to why technology in particular and other growth areas are getting hit. Quite simply, rising interest rates. And we can see the RSI trending downward. Now your MACD down here in negative territory. And this area too, technology has broken below this 50-day simple moving average. From here, in our next segment, I will share with you two areas, one in particular that is really suffering here amid this pull away from growth stocks. So let's take a look. Normally during this period, you would think that staples would fare well. Not so much. This particular group is down in par with the broader markets, but the chart is not healthy looking. Consumer staples normally is defensive. They provide products that individuals need, whether it's paper products and otherwise, but the staples area has other stocks and companies that are not necessary. You do need discretionary income, and that's going to be more in the line with perhaps cosmetics and so forth. But let's go ahead and move on from here, because I want to share with you some sub-industry groupings in the broader markets that are really super helpful as far as getting your arms around what is taking place and why. I use these ETFs. I'll go ahead and share it with you again, a 2-month daily price chart view. First up is the US dollar, and we can see that it's had a relatively strong week, and the up almost 1%. All about the safe haven aspect of the US dollar. So in turn, we did see commodities pull back. There are other reasons that commodities pulled back as well, but certainly the US dollar is one of them. Also, a strong dollar is not good for US multinational companies, hence a lot of those larger consumer staples names. Let's move on here. Take a look. I mentioned to you the increase in yields. In this case, we're looking at the yield of the 10-year Treasury, and you can see it has been generally ticking higher. It's at about 3.2. That 3% level for the yield on the 10-year is an inflection point in the sense that that's where you'll generally begin to see growth stocks falter. Higher interest rates reduce the value of future growth earnings for these growth stocks. So the other area, if we do get up to that 3.5%, that is an even more of a red or a hot button for these growth stocks, but we can see that already we are seeing a response. Moving along, volatility. This is another area where I would say you need to pay attention, because volatility up above this 200-day simple moving average, I'm using the VIX, also known as the fear index, and a lot of traders view a break above this blue 200-day simple moving average as negative for the near-term prospects for the markets. Generally, rising volatility will pull the markets lower. So that is another area to keep in mind. And then as we move on, I want to share with you some of these weaker areas that are really in particular impacting growth stocks and technology. Here's a view of the semiconductor ETF, and take a look. It is down about 6% for the week, really getting hurt. We can see the RSI, MACD in negative territory. A lot of cross currents taking place here, but certainly global growth fears. And then there is and was talk that the U.S., anyone that sold, for instance, NVIDIA and AMD that sold to China were going to be restricted. I believe that has been lifted, but in the end, semiconductors are really hurting. This is an area where I will share with you those inverse funds with the semis. Let's go ahead and take another look here, because I want to share with you a weekly chart to get into inverse funds at this point with semis down 7%. Might not feel like a great idea, but when you are looking at this longer-term weekly chart that would provide you with a longer-term outlook, we can see that we've broken below this 10-week, and your outside momentum indicators are trending downward. But more importantly, we can see that when this area does descend into a negative period, it can be long lasting. So from here, let's go ahead back to our list and take a look at another growth area. This is software stocks. IGV is the ticker symbol, down about 4%. And we can see this break below the 50-day simple moving average. Outside momentum indicators are negative. So another area among these growth stocks that is faltering. From here, I do want to go ahead back and share with you a chart give you a good view of the relationship, actually not here, so I will save that, but I do have a chart that reveals to you the relationship between the NASDAQ and rising interest rates, and it's really quite powerful as it relates to rising rates and the deterioration in growth-heavy NASDAQ. So from here, I did talk about sharing with you some other list and areas to keep on your, some stocks to keep on your watch list. So let's take a look at from 2008, one of the last great recessions. There were about 8 stocks that really outperformed the broader markets, and I view them as what are called recession stocks. And I think you'll see a theme here, and I do have them in a watch list, just keeping an eye on these names. First up, we'll take a look at Walmart. And of course, it is struggling a bit here. It did have that nice break above the 200-day on pretty good, certainly above average earnings back here at the end of August, struggling a bit here. We would need to see a break back above that 200 to get back interested again in that. But from here, I'm going to share with you a couple of other names that are in the same area as Walmart, and that is these discount retailers. Ross was another big performer 2008 during that recession. It's another stock that, very similar to many growth names, rallied up to this 200-day simple moving average, pulled back. So now on the lookout again for, at some point, a potential move back above that 200-day simple moving average to give us confidence. Another big winner, certainly outperformer in that recessionary period, is Amgen. And here we are with a daily price chart pulling back a bit today, but the company did have good news earlier in the week regarding trial testing for their small cell lung cancer product. and it did break back above these moving averages. But more for today's exercise is to share with you themes that if we do progress further and there are more recession fears, these are the types of names that will outperform. Here's another biotech stock, Vertex Pharmaceutical. Their drug is all about cystic fibrosis. We can see it is now still below this 200-day, but holding up. I believe it was up 3% on the week relative to the broader markets. So two themes overall at this point: biotech names and discount retailers. Of course, it makes sense. But here we are with another big performer in 2008. And you can look this list up, put those top 10 names during that recessionary period into a watch list and have it on hand. Here's a daily chart of McDonald's. We can see that it did hit a new high here back in late August and has pulled back, but it is in the throes of potentially resuming its uptrend. I will need to see the stock break back above this 21-day simple moving average with a positive RSI and a nice MACD bullish crossover to provide me with information that this uptrend has been resumed. And one last name that we can take a look at, again, going back to that recessionary period of 08, H&R Block was among the top 10 performers. And we can see this stock has had an incredible record here of the last 2 quarters, coming in with super strong numbers, trending upward, another strong quarter, pulling back with the broader markets. But those are the highlights as far as stocks that I did want to share with you from there. So from here, let's take a look at some of these inverse ETFs. And I will tell you some of the areas, and as I go through, I'll share with you which ones are super leveraged. By that, I mean 3 times the inverse. That's certainly going to get you more oomph, but also if the markets, if that particular group that it is inverting from does come back into play, do know that your downside is going to be equally powerful as the upside. But here we are looking at ProShares Ultra. So that implies that it is more than just the inverse. SSG is the ticker symbol. And this is all about semiconductors. And I shared with you that when they do begin to falter, it can be lasting. So we can see that it is trending upward here. This period from July into mid-August is a period when interest rates were dropping. So that did allow these growth stocks some leeway to trade higher. But with SSG, I added a 5-day simple moving average, super high volume characteristics this week as investors are betting that these growth stocks will continue to suffer in the face of an aggressive Fed relative to interest rates. And let's take a look at another area, and this is going to be relative to the Dow. This is the Dow Daily Internet Bear, but again, 3 times. So as the Dow declines, you will see this particular ETF trade higher. And then one other area, and this is going to be relative to the Russell 2000 small cap index. And we can see that it is certainly in the near term here on the rise. I'm going to put a 5-day simple moving average. When these stocks or ETFs get going, this 5-day is going to act as support, and then a pullback to that area can be a buy zone. Pointing this one out because it is poised to break above this 50-day simple moving average. MACD just now getting into positive territory, and your RSI trending upward and above that 50. So again, this is another one that is an ultra. So it is 3 times the inverse of the IWM or the Russell 2000. And then one last one that is relative to the NASDAQ. There are several out there. This is ProShares UltraShort for the NASDAQ. And this one has broken above that 50-day. We have the MACD now up here in positive territory, RSI trending upward, nice high volume characteristics. And I think I said last one, but I do have one last one. This is the SARK, and this is a fund that is the inverse of the ARK innovation ETF. So not quite as volatile. It's not giving you that 3 times. It's a little more steady, if I may. And we can see that it is generally trending upward with your momentum now up here in positive territory. So those were some ETFs to keep in mind for those that are nimble in your trading. You're looking for a way to hedge your portfolio. Keep that in mind, but always pay attention, have alerts as they do, particularly those 3 times ETFs can really move around. So from here, I did want to go ahead and review some of these commodity stocks that have pulled back. So let's take a look at Mosaic. This is a fertilizer stock. We'll take a look at the history, if I may. Here we are looking at Mosaic back here, March going into April. Big explosive move as Russia invaded Ukraine. However, on the rise prior to that. So these commodity stocks, and I will share others with you as well, they are and will act as a great hedge against inflation. This was a rising inflationary period. So at this point in time, yes, inflation is still quite high. However, there is really mixed certainly opinions as it relates to whether inflation has peaked or not. So that side of the trade is not as relevant or is not there. However, companies such as Mosaic have come in with super strong earnings. The beginning of August, Mosaic reported 211% year-over-year earnings growth. It's trading at 6 times. So characteristics there that are bullish. So let's take a look at what I would need to see to tell me that this area or this particular stock is back in an uptrend. I would need to see the price break back above these moving averages. We can see that the RSI is right here at that 50, so a break above that, and then a nice MACD crossover. So we have work to do, certainly above the 21, 5, and 10. So a little bit of traffic, but we are not that far away from a potential reversal. One other thing that you would want to pay attention to, and we can look at CF, another big fertilizer name that also pulled back. And what I wanted to share with you is also keeping in mind the price of fertilizers. And this is a 3-year chart. I'm using Y charts. And what I did want to point out to you is that we have certainly decreased from this peak back here in that March period, but we are still at elevated levels for these fertilizers, certainly relative to the last 3 years. So from here, I'm going to just take us over to some of these steel stocks. This is another area where these companies came in with excellent earnings. Here's STLD, and they did report in earlier in August, a nice uptrend subsequent to that, but we can see with that pullback. So STLD has pulled back to this red 50-day simple moving average, and it does appear to be attempting to reverse. Again, I will want to see that RSI up here. I want to see a break above these shorter term 10 and 21-day simple moving average. And the closure of China has been mentioned as certainly one reason these steel stocks are pulling back, reduced demand. But let's go ahead and take a look at the price of steel again with this Y charts view. This is a 3-year, and we can see it certainly has gone down from this elevated price up here in April of this year. But if you look at it from an historical precedence, we are still above pre-pandemic levels. So the price of steel is there. It's just going to be a case of whether that demand will outstrip and help this type of a stock. NUE is another name that was on the move to the upside and pulled back. So keeping an eye on those names. I think that's it for this week. Actually, I did promise 2 utility names. Let's take a look at one of them. Here's Southern Company, SO. We can see that it had a run up here to a new high in price pulled back, but the RSI never got negative. So had you owned it in this pullback, you could stay with it. We're still above here, above 50 on that RSI. MACD still up here in positive territory. I would say that would be one of the top names. These utility companies have been able to raise their rates, and that in turn is helping keep their growth. Also, Southern offers a 3.5% yield. Last up here, I'll share with you Sempra Energy, SRE, another one that's holding up remarkably well. Pullback stayed above 50 on that RSI, and we are poised now to break above that 10-day, which would be quite bullish, 2.7% yield there. That's it this week. Everyone have a fantastic long weekend. September does tend to be a tougher period for the markets, if you can imagine. So keep on your toes, and I will look for you here next Friday.